Okay, well, let's look at these hedge fund strategies that you've got in your ETFs. We'll take a look at ProPix. ProPix is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. All right. The first ETF, which is the longest running one that you launched it a couple of years ago, is your multi-strategy return tracker. The ticker on that is HFND. And basically, this is your bread and butter. This is what you're trying to replicate, the aggregate hedge fund industry returns. What does that look like? What's inside of this? And what's the goal for advisors, or for investors, I should say, if you're holding an ETF like this?
If our original strategy was really focused on proving out, it was basically a proof of concept of our technology. And so what we've done with that strategy is we took the 6 major hedge fund styles that hedge funds pursue, and we built an individual replication for each one of those, and then we combined the strategies together, essentially to get a single product that tracks hedge fund industry returns over time. And then, of course, doing so at a lower cost point than you'd get if you were investing directly in the funds. And so the product, in many ways, was really focused on a proof of concept. For some more conservative investors, they found it useful because it does pair nicely with a 60-40 portfolio over time in terms of providing a bit of diversification, because it creates, through the cycle, it's expected to have 60-40 like returns, but just with lower volatility and lower drawdowns. And some clients that we work with who have more conservative portfolios find it useful because it's only run essentially consistent with how institutional allocators run their hedge fund portfolio, which is to run it at something like bond risk, seeking a few hundred basis points over cash.
That was actually going to be my question, because if you look at how it performs against the S&P 500, it would have been better just to buy that index over, the last 1 years, even in 2025. So that's not the goal. It's more bond-like returns or preservation of capital versus return on capital.
Exactly. So it's in many ways you could think about it as just a spy for the hedge fund industry. And so the goal is to track hedge fund industry returns. Most institutional allocators target cash plus a few hundred basis points in terms of the goals for their returns. And so that's what the strategy has delivered. And probably more importantly, the goal of the strategy is to demonstrate that we can track how hedge funds are performing and positioned in real time, because that then has created the basis to be able to create some of these new strategies, which don't just take hedge fund returns as sort of a given out of the box, but helps transform those strategies into something that can be more cash efficient and complementary to portfolios.
So one successful example of that is the one that you launched a couple of months ago, the Global Macro ETF. The ticker on that is HFGM, and this is actively managed. In the time, it's only short period of time that it's been out on the markets, July, as I said, but it's doubled the returns of the S&P 500. Talk to me about the active component and, what it seeks to do relative to the S&P.
Yeah, what we've done this year across a couple of different strategies is we took, as I mentioned, those 6 hedge fund styles that were in our multi-strategy portfolio, and we broke out basically 3 of the most valuable of those strategies individually, and the Global Macro one being one of those strategies, along with Managed Futures and Equity Long Short. And instead of running those strategies in the same way that institutional allocators run them, which is at bond-like risk, what we've done is instead we're running them at a 2x target return, which is something closer akin to equity index risk rather than bond risk. And that's really important because what it does is it makes for a much more cash efficient exposure to those individual strategies than where you invest in a hedge fund directly, in those hedge fund strategies directly. And of course, they're run at a much lower cost point than what a typical hedge fund investment would be.
So
Now,
sorry, just flesh out what's different then when you say run at 2x. Like, is it leverage or what do you?
well, through the use of futures contracts, we effectively take on twice the notional exposure
I see. Okay.
that the managers would have on run at sort of bond-like risk. And so that's really what we're doing. And that brings it, I think, in for a lot of investors when they're looking at some of these, looking at diversifiers, they want to look at those. They want the diversification without giving up the return potential, right? And so I think by targeting equity index-like risk, we're able to balance those desires. Global Macro in particular has done well this year. Interestingly, because of its ability to be flexibly long and short assets in a wide variety of different environments, one of the interesting things is if you look at Global Macro strategies over the course of, say, the post-GFC period, the two periods where Global Macro has done the best have been in this most recent period, where essentially all assets have gone up and macro strategies have been able to take advantage of that. And in 2022, when all assets went down. Why? Because they could go long and short. And so in a lot of ways, when I think about the Global Macro strategy, it's in many ways an all-weather alpha, the sort of alpha strategy that can provide diversification benefits both in down markets and in up markets.
Highly correlated markets, though, sounds like all things going up, all things going down.
Well, it's a question of whether there's what are the big macro drivers, right? Because that's basically what determines outsized performance. And so, as a simple example, when you say everything going up or going down, in 2022, global macro managers made a ton of money. They were short stocks and bonds and long gold and oil, right? So it's not everything going up. It just happens that in this period, essentially easy money relative to conditions, and particularly around Jackson Hole and the shift of the Fed's reaction function, that's been a really important driver of lifting all asset prices. And so that's what macro managers have taken advantage of.
How would you pair that against the HFEQ? This is your equity long short. So how is that different from maybe your global macro?
Yeah, the equity long short strategy, and if you look at most long short equity hedge funds, they are not market neutral. They are taking, they generally have a positive exposure to equities and then are adding alpha strategy on top of that, meaning trying to add additional returns beyond just passive investment in equities. And so in many ways, what you can look at that strategy and think about it as as competing with other actively managed equity products. And we've written about this actually on our blog at unlimitedfunds.com. If you look at hedge fund equity long short strategies relative to all the actively managed equity strategies in the market, what you see is notable outperformance of hedge funds relative to sort of traditional mutual fund actively managed equity or ETF active managed equity. And so that's really what it's competing on. So maintaining that equity exposure and looking to add something on top.
What is the Managed Futures ETF looking to accomplish? It's flat since launch. The ticker is HFMF.
Yeah, Managed Futures, for those folks who don't follow, is really about trend following, and that those sort of trend following strategies generally demonstrate uniquely differentiated performance during down market environments, particularly where we have long cycles of down market environments. And the reason why that is because they're typically strongly following price action in terms of creating positions. And so if you have stocks falling for an extended period of time or bonds falling for an extended period of time, they do particularly well. And so with those strategies, I think a lot of folks are interested in those sort of defensive style strategies, particularly ones that have over time a positive return. So ones that aren't essentially like a tax or an insurance policy, but have a positive return. The challenge with those strategies is you got to stay in them until they pay off. And one of the ways that you can do that is by having a more cash efficient exposure to those strategies. So in dollar terms, it's just a smaller line item on your portfolio that you can stomach. Sure, this thing's chopping sideways for a little bit, but it's there to help protect me in the event that there's an extended asset market drawdown. And so by offering that strategy at a 2x target return, that basically helps improve the cash efficiency and keeps folks more into those strategies than if they invested at a lower expected return.
Bob, it's been an absolute pleasure. Thank you so much for joining us and spending time with us today.